Now we come to our last segment. And for those that have stuck with us the whole time, we always thank you. If you're bouncing around, also great. We're looking to break it up a bit more so it's a bit more digestible, because I do know I'm long-winded, and I apologize for that. So we try to highlight things that are important. And again, we'd like to remind you, please like, share, subscribe. Your support is appreciated. Getting this into as many people's hands as possible, only helps us further, and hopefully helps them in providing necessary information. So one of the things that we wanted to kick off this segment with is looking at China versus the U.S., because it's, we continue to have this tit for tat backdrop. So the U.S. Treasury, and this was from Friday, the U.S. Treasury Department sanctioned 7 Hong Kong officials for their role in eroding the city's democratic institutions. Several of them were either already sanctioned or sanctioned differently. And then on the same day, the U.S. Treasury, State, Commerce, and Homeland Security Department issued an advisory that warned U.S. companies of the dangers of doing business in Hong Kong. Each of these keeps getting ratcheted up. If you remember the previous week, it was another 54 companies went on the sanctions list. And the way it was addressed was the national security law, warrantless electronic surveillances, association with U.S. sanctioned individuals or entities, which keeps expanding back to those companies, retaliation by Chinese authorities against said sanctions. Washington's advisory is something of a self-fulfilling prophecy if you think about how it's going to be essentially turned around. And that's where we keep talking about this escalation point. And as we said before, whether Trump or Biden won, it did not matter. We are on a path that we've been on since the Tiananmen Square. Ebbs and flows within that, but it has been at a continuous trend, and this again moving things along this level of Cold War. So as the U.S. continues to pressure China and Beijing builds out its ability to respond to American sanctions, foreign companies will increasingly be caught between the devil and the deep blue sea, as said by Trivium, because I think that's a great way of highlighting, because China and Beijing in general and the U.S. are going to continue to go back and forth, which is why if there are companies out there watching this, if you have not moved or started to move your supply chain out of China or diversify them, do that now. This isn't a blip. This isn't something, these things take years to develop. This types of animosity, the way it gets, and then once it's done at this point, there is a point of acceleration where, think of it coming down a hill where as you're coming down, the ball is getting bigger and bigger, and the steepness is accelerating. And that's where, again, this is going to run out of control, where you moving assets into it. China and India are moving more assets on the borders. We are at a point of conflict that at any time, something could go wrong. And there's something that, one of the individuals that I follow very closely, because I think he's fantastic, they wrote the book, Trade Wars, looking at the different trade war sides, the Michael Pettis and Matt Klein. And they talk about in their book, the trade deficits are not a problem when they are balanced by high domestic investment funded by foreign capital. So that's something that the U.S. was the beneficiary of. Even though we were exporting a lot, we still had a lot of domestic investment from external areas, which was what we saw in the 19th century. And that's where, and I think they do a really good job in the book of highlighting how that's pivoted over time, where now we're just a net buyer, but we're not seeing the same type of foreign investment. And here's a quote from Michael from Twitter. There are serious problems, however, when they reflect foreign inflows that drive down domestic savings rather than drive up investment, as has been the case in the U.S. for several decades. Washington is right to want to address these imbalances forcefully, but it is important that it understands the real sources of the imbalances. Vietnam does indeed have a savings imbalance in a well-functioning trade and capital regime. A poor, rapidly growing economy like Vietnam would be a net importer of capital, not a net exporter. But in the grand scheme of things, it is a fairly minor contributor to U.S. imbalances. Its huge bilateral surplus with the U.S. does not reflect its true role in much the same way Mexico's trade surplus with the U.S. does not reflect at all Mexico's role in global imbalances. So what is it saying? It's essentially saying that we have an imbalance with Vietnam, but it's something that is of consequence in a positive way. And that's what we keep talking about when we look at opportunities in Asia, in the Southeast Asian nations. And we've always been highlighting Vietnam. This can't be said about China. And that's where the problem continues to mount, because as the U.S. looks to diversify, and we're seeing that diversification, as we talked about in the previous segment with Japan, South Korea, India, Taiwan, and now Vietnam, this is going to increase, which is, again, why we continue to see some of these pivots. Now, on the other side, a more serious charge, so another charge from the U.S. to China. The U.S. is saying that hackers employed by the Ministry of State Security, China's spy agency, were behind the Microsoft Exchange server breach disclosed in March. Microsoft, they were the ones that essentially said 250,000 servers were impacted, and they pointed the finger at China. So U.S. has high degree of confidence it was China. The U.S. also indicted 4 MSS-affiliated Chinese nationals on charges of conducting a years-long campaign targeting sensitive technologies. U.S. authorities have made accusations again, but this is now also being backed by the EU and NATO in general. This is a first. It's a first where the U.S. said something, and now EU and NATO are coming out and saying, yes, we agree with this. Again, putting more pressure, because remember, China and the EU still have put on hold their trade deal because they can't come to terms over human rights, and this is just going to ratchet up further. Beijing's mission to the EU called the accusations groundless while asserting its own hacking victimhood and calling for international cooperation. The Biden administration achieved a minor victory in coordinating allies, and I think that is going to become a much bigger problem. Now, last catch-up side. So on the other side, what happened? Well, Beijing refused to grant U.S. Deputy Secretary of State Wendy Sherman a meeting with Chinese counterpart. Sherman was originally scheduled to stop off in China following a visit to Japan, South Korea, and Mongolia, and it was canceled. So whoever started it, U.S. and Chinese officials stonewalling each other, is hardly a recipe for building trust. Sherman's visit was considered a first step toward a Biden-Xi meeting later this year, which again is becoming less and less likely, as this is showing just where the problems continue to arise between the two powers. So this is where we just wanted to highlight again some of the different backdrops when we look at retail sales. We covered a lot of this last week, but we just wanted to point out again, when we look at property investment coming under pressure, down 1%, that is now under even more when we look at Evergrande and how Hong Kong HSBC has stopped issuing mortgages through their Hong Kong office. There is a lot of pressure that's coming into the property investment side, which is filtering down into industrial production, fixed assets, ex-rural, because it's all filtering down into that. And then when you look at industrial production, we have to consider how bad a lot of these floods are that we talked about in segment 1, and how that's going to impact industrial production and retail sales. Again, more pressure to the GDP side. So real GDP expanded 7.9% in 2Q from a year earlier. This was slightly below the consensus of 8%, and industrial production rose 8.3% from a year earlier in June, less than May's 8.8% rise. But remember, May had a lot of backing in terms of deals, and again, May was deemed consumer month that was promoted by the local government. Fixed asset investment increased 12.6% in the first half, compared with an expansion of 15.4% that compared to expectations of 12%. Retail sales climbed 12.1% year on year, but it continued to come under pressure and again is slowing down overall, which is well above some estimates, but as we look forward, has come under pressure, especially when you look at it over the last 2 years, trying to average out and kind of take away some of that 2020 year-over-year bumps. So what do we continue to see? And the reason why we wanted to start off with some of that recap is not only the other side of the equation with the amount of lending that has happened over that time period. So remember when we talked about the triple R cut, and what have we seen with the triple R cut? The triple R cut brought things down by 50 basis points, but the 1-year loan prime rate and the 5-year loan prime rate were held unchanged at 3.85% for the 1 year and 4.65% for the 5 year. Again, the triple R cut was something that happened, but it was more of a preemptive, and this is just showing that there's going to be a limitation for what the PBOC is doing. So as we've said, to stop the decline of credit impulses, but not create this huge surge in credit impulses either. So China, it's trying to further cut costs for exporters. So they've come out and they said that they're going to continue to cut prices for exporters as they keep trying to rebalance towards the private sector. So state-controlled urban employment and private urban employment continue to drive higher. Chinese exports are dominated by more domestic firms. So they're trying to protect pricing, trying to undercut this international price as PPI, as we've been showing in China, has exploded to the upside, and they're still trying to be competitive in that market because it's so important for the private enterprise, which is a huge employer. And employment continues to be a struggle within China, as we continue to see, and is reflected by the slow purchases within China, consumer, dual circulation strategy continuing to struggle, which is when we look at the triple R cut, again, looking to boost some of that credit cycle, annual change of reserve requirement ratios, and then what normally happens because of it. But it's going to be a very slow grind because credit impulses will come back, but they're not going to grow because they're still looking to take capacity out of the market, and they're so far from achieving their goal. Now, could they absolutely panic and try to drive this back up? Yes, but their ability to do so is mitigated by who is the buyer of last resort and how is this debt going to be paid off, as more and more of it is being financed by tax revenue with such an elevated amount of capacity. So now let's look at the business cycle indicator. So credit impulses have been pulled down, and the business cycle indicator is only now starting to get pulled lower. So let's look at this in terms of where things have gone, coming back to all of the data that has come out in general. So for anyone following China, and this is something that I wrote in my insights from Friday, and I'm just going to read it to you. It's a mixture of some of the things that I was able to pull together. For anyone following China, I'm sure that the statement doesn't surprise you in terms of the how difficult some of the data is, but trying to understand what is actually happening is more important given the implications on global trade and growth. Retail sales beat a lowered number with broad metrics showing issues kept rising on a month-over-month basis, because remember, they took it down. GDP growth grew by 1.3% quarter on quarter, much higher than the 0.4% quarter on quarter growth in the first quarter, but still below the 1.6 average Q2 growth rate for the previous 5 years, excluding 2020. So again, still seeing that net slowdown. The 2-year average growth rate for retail sales in the first half of 2021 is way below the equivalent for industrial production, 4.4% versus 7%. The good news is that in May and June, retail sales growth outpaced industrial production. But again, they were supposed to do it in May and in June because of the additional support that they received on the retail sales driven by the government. Although year to date, because of a terrible January, industrial production still grew marginally faster than retail sales, which is going to come under pressure because of flooding and where it's located. May was also retail month, and many companies offered broad discounts and sales. The GDP expectations in the market remain at 8.5% or higher, where it is likely to be much closer to our estimates of 6% to 7%, especially when we factor in broad slowdowns on the ground. While I can highlight what the underlying data says, it is important to recognize that for now, GDP growth in China is still mainly a political decision and has little to do with real underlying economic drivers that can only deliver sustainable growth rates of roughly half the GDP targets. The government is also reducing their expectations of retail activity with a new reduction. On Thursday, the Ministry of Commerce published the 14th five-year plan for commerce development, which now takes things down from an expected growth from 10% to 5%. So then when we look at local government bond issuance cumulative year to date, you can see that they're achieving their goal of being below 2020, but still not getting to where they need to of this draining the system. So again, coming back to the issues that we're seeing on both sides of economic growth and where some of these issues are. And the problem is where they're having these issues is at areas like Inner Mongolia and Jilin that are getting decimated by floods. So their crops are going to get decimated. Their industries are going to get struggled, and they have to roll and refinance risk. So banks and insurers don't feed the monster. There's been a lot of chatter in China's financial industry this past week about a certain document number 15 sent to banks and insurers by the industry regulators. The document ordered financial institutions not to help local governments hide or increase hidden debt by lending to local government financial vehicles, or the LGFVs. This is where we continue to see this pressure coming full circle back to segment one. And they're used by local governments largely to fund infrastructure. Going to be an issue in general. Banks and insurers must not provide liquidity financing to LGFVs that hold implicit government debt. Seeing as this is the major purpose of many government debt, the order could see many funds cease operations. The CBIRC didn't close the door for debt swaps, although it did make swaps more difficult by centralizing approval power in the head offices of banks and insurers. Individuals inside banks and insurers found responsible for hiding or increasing implicit debt will be punished according to the rules. The central bank has been zoning in on the off-balance sheet debt of local governments this year. Official calculations about a quarter of provinces will use more than half of their fiscal revenue between now and 2025 to repay capital with interest. Tax revenue depletion while these pressures continue to mount. All the while, a few provinces face significant maturity risk in 2021. So if you look at who has to rebalance, who has all of these maturities, how are they going to do that given the pressure that resides on balance sheets within China and just how the market is viewing their debt risk? So then when we look at Chinese loan prime rates, the steady fixings for China's loan prime rates reinforce the view that the People's Bank of China isn't keen to aggressively ease. An earlier reduction in banks' required reserve ratios, the RRR, triggered speculation that the LPRs might also be lowered. We've been saying that is not going to be the case. Given the solid state of the recovery, which is starting to falter, that is unlikely at this time. We think that this is something that is not going to be off the table, and it's going to be more targeted because remember back to what we were saying with private enterprises getting products into the international market, trying to subsidize some of this employment on the private side. It's going to be more targeted towards the micro and mid cap companies because that's where the capex is shrinking. That's where hiring isn't happening. That's where pain remains on this on their balance sheets within the system. Not so much the mega caps or the SOEs. This is why it's going to be more targeted because they still need to try to drain a lot of this capital out of the system. While all of this happening, Evergrande bonds tumbled to record lows because the property giant stock tumbled, extending its two-day loss to 25%. Several of Evergrande's local and offshore bonds sank to record lows, with its dollar note due 2025 falling to 54 cents. Bonds of other junk-rated Chinese borrowers declined, while a gauge of developer shares dropped to a three-year low, because remember, they're trying to go after some of this debt. So long simmering doubts about Evergrande's financial health intensified this week after the developer had a $20 million bank deposit frozen by a local court and was hit with sales bans by a city government alleging it failed to set aside enough funds in escrow accounts. The city later removed the bans, providing some relief for the stock, but investors remain worried about the company the company isn't selling properties and other assets fast enough to repay its $301 billion of liabilities. So then when we look at Evergrande and then look at Chinese real estate loans, you can see that there is additional pressure coming into this as they're trying to take some of these loans out of the system. And this is where the real estate loans starting to roll over, but they're still too high, which is why we keep talking about industrial, foreign direct investment, and more importantly, property investment, which is where we continue to see these pressure points. And this is where despite short-term risk and market volatility arising from potential credit events, government officials are likely to keep policies tight on developers' funding conditions and the broader property market, as they see it as an essential to prevent the buildup of an even greater systemic risk. We expect credit risk to continue in the foreseeable future. I think that kind of sums up where those pressures remain and why we've been harping on the debt side of the Chinese bubble so aggressively, because these are some of the key areas that we see as being some big overhangs or landmines within not only just the debt market, but just the global market in general, because China is the second largest economy in the world and is really struggling to right size at this point in time. So I know we covered a lot. If you have any questions, please reach out. We'd love to hear from you. If you want to reach me on Twitter, email, or in comments, it is an absolute pleasure trying to share this information with you. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.